Do you want to retire in poverty? Of course, it's a silly question. I wouldn't expect anyone to say yes to that. So take note of these things if you want to retire and not be in poverty. Focus on what you can do and things that can really get you to where you want to be. Allowing fees to hold you back. Here's the hard truth. Regardless of what kind of investment you decide to do, there's going to be fees. In fact, you might actively seek for companies that charge you reasonable fees. Part of those fees is used by those investment companies for security and insurance of your investments. If a company doesn't charge fees, you need to ask yourself, how do they have security? How are they protecting your investments? They also must be doing it another way. They're probably not open about it, about how they're doing it. Then it's probably via some means that could potentially compromise you. For example, they could be selling your data, they could be selling it to advertisers, to hedge funds. So keep an eye on this, it's important. So reasonable fees are okay. Number 2, not planning for taxes. Like fees, taxes are a material drag on returns. Taxes are more insidious because we have less control over them and they're hidden when evaluating portfolio performance. In fact, they're typically greater than or equal to the amount of investment management fees. Yet the wealth management industry tends to pay lip service to the tax drag on a portfolio. They use sophisticated software to track investment performance, but tax drag is something they typically report. So you have to optimize for after-tax returns. One way of doing this is doing a Roth IRA instead of a traditional IRA. That means you will have to pay taxes when you put the money in, you won't get that tax benefit, but when you cash out at retirement, there'll be no fees for capital gains. We also suggest, as always, for you to consult a financial advisor and talk to an accountant. Number 3, try and time the market. There are a lot of people who predict market developments. Some of them are often right, most are wrong. But even the ones who are often right aren't right all the time. It would be nice if they would only follow their advice when they're right. Unfortunately, we will not know until it's all done, but then it's too late. Don't make changes to your portfolio based on predictions by these market experts, especially if their predictions are based on feelings of fear or greed. This is called timing the market. Think about it. If a proven factor or set of characteristics signal market tops and bottoms, everybody would know about it. Then buyers and sellers would use this information to set their prices, and it would destroy the signal patterns, and basically everybody would have this information accessible to them. So it can't be true. You can't time the market. Going for absolute maximum returns. It's well known in the financial industry that as a group, active managers underperform their passive benchmarks. This means the odds are against investors when they use active managers. Investors harm their portfolio's performance by switching active managers or strategies based on recent performance. They tend to add funds or strategies that have recently performed well, and then they trim the funds that aren't doing so well. Most of the time, taking the opposite approach is the best course of action, as an investment manager's performance will tend to regress towards the mean. You also need to understand that sometimes time is important, more important than returns. There are assets that are known for huge returns, but are also volatile and unstable. Take the market, for example. Yes, long-term the market always will recover, but we're talking about the entire market. Specific stocks are an entirely different story. Back in 1990, the S&P top 5 were GE, Exxon, Pfizer, Citigroup, and Cisco. Exxon has dropped to the top 24, and the rest didn't even make the top 30 in the most recent list. So don't look at maximum returns right now. Think of the future. Some assets may not generate large returns, but can rise steadily over time. Fifth thing you need to look at is having a short-term focus. This is connected, obviously, to the previous talking point. Over the short term, investment markets are unpredictable and chaotic. Now, news, events, and investor psychology cause the market to gyrate, surge, and fall. So you got to make sure you protect all your investments. All assets and investments can tank, and some can literally disappear and take all your money with it. But if you have an hedge, an asset that moves in the opposite direction when the market pulls back, you'll be in a better position and you'll be okay. Gold is typically that investment. Gold is what central banks and billionaires use to hedge against inflation and all kinds of economic troubles. So if they're trusting gold, you should too. If you have any questions, you just want to learn about what we do, you're looking for a no pressure conversation, give us a call, 877-646-5347. We have tons of free information. We have gold guides, silver, a lot of good information to help you learn about what we do at Noble Gold Investments.
If you're interested in investing in precious metals and you want to talk to a no-hassle representative that has experience in physical metal, give us a call, Phone number is 877-646-5347. Our phone lines are always open, and we're happy to answer any of your questions.